It's on. Thank you. Okay. Good morning, everyone. Welcome to the Common Investment Meeting for June 15th, 2016. We've got a full agenda today, so I think everyone would appreciate if we can, move through it as expeditiously as possible, which is not to say that folks shouldn't make all their comments and ask all their questions, but if we can minimize the noise, I think it would be very helpful for everyone. So first thing we're going to do is convene each of the boards. So let me start with NYSERS. Karen, could you call the roll? Here. No.
Here.
Are you using your mic because it's hard to hear you?
Here.
Oh, thank
Susanna.
Oh, sorry. They're all extra.
Borough President Manhattan. Borough President Brooklyn.
Present.
Borough President Queens. Borough President Staten Island. Borough President Bronx. International Brotherhood of Teamsters. Here. Transport Workers Union.
Here.
District Council 37.
Here.
We have a quorum.
Thank you very much. Next, let's do the teachers' retirement system. Patricia?
John Adler,
Here.
Thomas Brown,
Here.
David Kasansky,
Here.
Deborah Penny,
Here.
Charlotte Beyer,
Here.
Susanna Vickers.
Here.
We do have a quorum.
Thank you. Next, let's do the fire department pension fund. Lee?
Mr. John Adler,
Here. Still here.
Ms. Susanna Vickers,
Here.
Mr. Antonio Rodriguez,
Here.
Mr. Steve Cassidy,
Edward Brown has Steve Cassidy's proxy.
Mr. James Levin, Mr. Addie Brown,
Here.
Mr. John Kelly,
John Kelly will be here in minutes. We have his proxy.
Use the mic, please, so the
Sorry.
scribe can hear
John
you.
Kelly's on his way. We have his proxy.
Mr. James McGowan,
Here.
Mr. John Farina,
Here.
Mr. Paul Furrow,
John Farina has Paul Farrow's proxy.
Mr. Thomas Phelan.
Here.
Commissioner Douglas White will be here in a minute. We have a quorum. Let me start.
Thank you, Lee. Okay, next let's do the police pension fund. Sends?
Police Commissioner, and not here. Mayor,
Here. John Adler representing the mayor.
thank you. Department of Finance,
Antonio Rodriguez representing Finance Commissioner Jack Jiha.
thank you, Antonio. Controller,
John Dorsa for Controller Scott and Stringer.
thank you. PBA,
Dan Torelli with the proxy for Patrick Lynch, John Puglisi, and Mubarak Abdul-Jabbar.
Joe Rayo, PBA. DEA, not present. CEA,
Mike Endall representing Roy Richter.
all right. Mr. Facilitator, we have a quorum, thank you.
Thank you. And Board of Education?
Morning, John.
Morning,
We do
Sam.
not have a quorum. We will resolve the recommendations at our board meeting scheduled for June 22nd, and our investment committee is represented here.
Okay, thank you. Okay, next item of business is with NYSERS. Karen Mazza, can I call on you?
Good morning. Good morning. As many of you know,
Can't hear you, Karen. You need the mic.
I'm sorry. As many of you know, excuse me, our Deputy Executive Director, Linda Chiarello, is retiring after 40 years of service with NYSERS. Many of you know her as extremely knowledgeable and helpful. So the board has asked me to read the following resolution into the record to honor her service. Whereas Linda Chiarello began work at the New York City Employees Retirement System, NYSERS, on July 6, 1976, as an assistant retirement benefits examiner. And whereas Linda successfully rose through the ranks of NYSERS staff, becoming the Deputy Executive Director of NYSERS in July of 2006. And whereas Linda has led NYSERS through administrative, legislative, and technological changes with vision, grace, and calm. And whereas during her 40-year tenure at NYSERS, Linda has been a role model, having trained and mentored and developed hundreds of NYSERS staff members. And whereas during her career, Linda has counseled innumerable city employees at all levels to help them secure their retirement. And whereas throughout her career, Linda has always acted in a professional and distinguished manner, treating all NYSERS members and staff fairly and respectfully. And whereas Linda has exemplified the role of trusted partner to hundreds of thousands of City of New York employees, therefore, be it resolved that the trustees and staff of the New York City Employees Retirement System offer Linda our deepest thanks for over 40 years of service, leadership, and friendship, and be it further resolved that we wish Linda a long, joyous, and healthy retirement. Thank you.
Thank you. This was certainly unexpected and very humbling. As I said, the last 40 years was all my pleasure. Thank you.
So I think we actually need a motion and a second from the NYSERS board. Is there a motion?
So moved.
Is there a second?
Second.
Any discussion? All in favor of the motion from NYSERS, please say aye. Aye. All opposed, please say nay. Any abstentions? The motion carries. All right.
That's resolution number 1.
Thank you. Okay. Moving on, it's now time for the total fund performance overview and performance by asset class. Mr. Evans, please take it away.
Thank you very much, Mr. Adler. I am going to start by turning this over to Mike Haddad, who's our group head of public and tradable securities and our macro guru at the Bureau of Asset Management, because the first quarter of 2016 was a dynamic quarter. Just about everything you could wish for in macro movements happened during that quarter. We're going to spend a little extra time going through the macro environment because I think it's very important to understand the context in which the rather straightforward returns came, but they came after an awful lot of rock and roll. So let me turn to Mike Haddad to start us off with the macro discussion.
Thanks, Scott. Appreciate it. One thing, just to start with, as Scott said, it was a very Is that on? Okay. A very unusual quarter, and I'm going to go through my take on things, and I would encourage the audience, which is not a bashful audience, to interrupt at any point with any questions or comments. It might be more useful to do it during that time. Most of the time is going to be on first quarter. My last slide is on Brexit, which I think is not a review, but a preview, and I think worthy of a couple minutes of our time. So first quarter, as Scott said, I had used the words unusual and difficult to explain, so I'll default to dynamic. But to set the stage going into Q1, let's recall Q3 and Q4 and a couple key events. Q3 was marked by the August devaluation, the surprise devaluation of the Chinese currency. Returns in the quarter were all very difficult. Developed markets were down 7 to 10%, EM equities were down 18%, and bond returns were mixed, with credit having a negative return and governments offering a positive return. Q4, which I spoke about 3 months ago, I labeled stability, and underneath stability was a challenging environment, but yet markets were relatively stable. Key event of Q4 was the Fed's interest rate hike. First one post-financial crisis, first one in 10 years, and a big deal. Returns in the fourth quarter for equities were all positive, 5 to 6%. Interesting enough, EM, after a minus 18% quarter, was unchanged. Bond returns were slightly negative, primarily due to the Fed rate hike. So that kind of set the stage going into Q1. So before I jump into Q1, a couple interesting statistics on Q1 I'd like to share. The first 10 days in the U.S. equity market were the worst rate of return 10 days ever in the history of the U.S. stock market. big deal. The second interesting statistic, first time in over 80 years that the U.S. equity market started off down 10% or more to finish unchanged or higher by the end of the first quarter. So I kind of gave you the clue 80 years ago. The year, 1933. Not that we're in that environment, but it's a statistic. So let's hop into returns to begin with. As Scott, you've seen this slide before in this presentation where we list the major asset classes, the indices that we mark your portfolios against, and then returns by a few different metrics. From a very high level, you look at the first quarter, the Russell 3000 was up almost 1%. No big deal, boring quarter, right? Developed equities down 3% in the first quarter versus positive 4% last quarter. Again, no big deal. I would argue differently. So on this slide, I've broken down returns into the first quarter between the first half of the quarter and the second half of the quarter. I conveniently chose Feb 11, which was the low in the market, so there's nothing magical. I just that was the obvious date. So look at the different numbers. In the first half, all down double digits, and the second half back up double digits. So I'm going to spend my time sharing with you my lens on what happened in the first half of the quarter and what happened in the second half of the quarter. So I chose A Tale of Two Quarters, obviously a metaphor for Dickens' novel, A Tale of Two Cities. And continuing the metaphor, the markets were treated similarly to the French peasants prior to the Revolution, poorly. So it begs the question, why? Three things. China, once again, it seems like we talk about China all the time. Second factor was U.S. recession fears and profit margin concerns. And third, lack of confidence in central banks. So I'm going to go into each one of these individually. I'm going to start with a slide here. The blue line is the Chinese stock market, measured on the right-hand scale. The yellow line is the Chinese currency, measured on the left-hand scale. So China is in a very difficult position that's in the financial press every day. And just to kind of recap from a very high level what's going on, growth is slowing. There's a transition away from net exports and fixed investment to a consumer-led economy. At the same time, they're trying to provide liquidity to the markets and to the economy to get this transition done while they're trying to deflate a credit bubble. On top of all that, they have what's widely believed to be a currency that is overvalued, but at the same time, they're trying to manage that devaluation process. So it leads to just a whole host of issues that no central bank or policymakers have tried to handle or have handled successfully. So again, a little backdrop, if you recall, 2015 for the Chinese stock market, it rallied tremendously in the first half of the year, mostly on margin purchasing, and then it plunged in the second half of the year. You can see those lines like pre-September. Finished the year slightly down, and at one point over 1,000 shares were suspended from trading. This was all 2015. So to start 2016, the CSRC, which is the SEC equivalent in China, stands for the China Securities Regulation Commission. They instituted circuit breakers to start the year. So a circuit breaker, in theory, is meant to dampen volatility in an equity market. And what it simply does when markets are down a fixed percent that they decide upon, they suspend trading for a period of time. They let market participants gather information and make more well-informed decisions. So again, these circuit breakers were instituted to start the 2016. So how did they do? Day 2, the circuit breaker was hit, and the stock market was closed at minus 7.5%. Day 4, the same circuit breaker was hit in 29 minutes. Day 5, the circuit breakers were eliminated. Several weeks later, the chairman of the CSRC resigned. So some questions about the effectiveness of that policy. The Chinese stock market was down 10% in the first week of January and down 25% by the end of the month. At the same time, as you can see, the Chinese currency was weakening. It was sparking fears of yet again another devaluation, whether planned or unplanned by the Chinese authorities, and that just adds to the negative sentiment that was in markets at the time. So on top of this, with the uncertainty of the Chinese stock market, other stock markets were getting sold in conjunction with this one. So this fed into the fears of a global recession. At the same time, the U.S. to start the year, basically through January into mid-Feb, most of the economic data came in weaker than expected. And concerns in the market were that the U.S. economy was going into recession, and the U.S. economy has been the strongest economy in the developed world, and if the U.S. was into recession, the world was going into recession. So this set off a yield decline amongst the developed market bond markets. So what I've tried to show you here, the yellow line is the US 10-year note, with the scale being on the right-hand side, and the green line is the Germany 10-year note, and the red line is the Japanese 10-year note. So you can see the size of the declines going into January and into mid part of the quarter. The third factor is what I term as losing confidence in central banks, and losing confidence both in the effectiveness of their policy decision as well as their efficacy to influence markets and stimulate the economy. So again, I got to go a little backdrop going into where we started. Two big central bank meetings in December. The ECB in December decided not to further ease rates, despite overwhelming evidence arguing for it, as well as market expectations. The second thing that happened was the Fed raised rates that we discussed before. So we're in this environment where central banks, who have been extraordinarily accommodative for markets and the economies, going into the beginning of the year have turned less accommodative. We can argue, and historians will argue for a long time, whether QE helps the economy or not, but I think it's unequivocally agreed upon that QE does help asset markets. So we turned the calendar into 2016. The Fed's first FOMC meeting was on January 27th. The statement on the slide is the balance of risk statement, which happens in the last sentence of the second paragraph of every FOMC statement. So this balance of risk usually says something about the balance of risks on two factors: employment and growth, and inflation. This statement, in convoluted Fed speak, basically passed on making a balance of risk assessment. This is the same central bank who tightened a month earlier, 6 weeks earlier. So what changed in 6 weeks that they are unable to issue a balance of risk statement? Obviously, it was the impact in financial markets and global economy, but it's important to understand how infrequently they don't give a balance of risk statements. In the last couple decades, 3 times. April of 2003, the beginning of the Iraq War, October of 2007, the beginning of the financial crisis, and again in August of 2008, in the midst of the financial crisis. So for the Fed not to give a balance of risk statement is adding to confusion in markets. 2 days later, their esteemed colleagues in Japan made a decision to go to negative interest rates. A surprise to markets, and this had a very negative impact on financial markets for 2 reasons. One, negative interest rates are damaging to banks' profitability. From 2 perspectives. It hurts their net interest margin because they're lending money, and with lower rates, they lend money at a lower rate. And secondly, the negative interest rate applies to the bank reserves that are held with the central bank. So instead of receiving money or not paying any money, now the commercial banks have to pay money to the central bank to park their reserves. So this set off a global decline in bank stocks. The second thing that it did, it changed psychology about central bank action going forward. So again, they chose not to increase QE, but to go to negative interest rates. So QE, without a doubt, helps markets, so this kind of led markets to think there's no more QE. So that's the environment that we're going into February with lack of confidence in central banks. What changed? These same central banks quickly pivoted. They pivoted in direction. They pivoted in the intensity of their message. They pivoted in the level and frequency of communication, particularly the People's Bank of China. And lastly, and arguably most importantly, they became coordinated. So the first one was the G20 meeting in Shanghai, which in market lingo, they've kind of set a currency détente or some kind of coordinated agreement. So what happened here? Let me just quickly go through these. Bring the slide up. I take you down to the third box on this slide. What happened at G20 was these were the key phrases that came out of that statement. And China convinced the world that they were not going to pursue a competitive devaluation, and the world central bankers held hands and agreed to be more coordinated in both the direction of their policy and the forcefulness of their policy. So this really helped calm markets. But prior to that, I'm going to point you to the first box in this. The chairman of the Federal Reserve, by legislation, has to testify in front of Congress twice a year on monetary policy. So this was a key statement that Yellen said on February 10th. And again, this is a central bank who had tightened in December, and she makes this statement about international factors influence their outlook on growth. The second point on this slide, the second box, was Draghi's speech a handful of days later. Again, so this is the guy who didn't ease when everyone expected him to in December, basically saying what he's willing to do, and in market psychology, this was the pre-announcement to the ease that they announced in March. Furthermore, having to do with the G20 Shanghai Accord, the first two boxes were speeches that were delivered out of Shanghai by U.S. participants in there. So Bill Dudley is the head of the New York Fed and a member of the FOMC committee. So not only in this bullet point does he talk about concerns about growth, but he actually thinks they're tilted to the downside. So this isn't a Fed that's going to tighten if it was up to him. This was a Fed that was going to ease. And the second one came from our Treasury Secretary about currency devaluation and how that had been greatly reduced. And the last box on here is the easing that the European Central Bank delivered, which was greater than expectations. So what did this change in central bank action and rhetoric and coordination do? Had impact on a few key things in markets. First thing that changed, one of the things that changed was the market expectations of future Fed hikes. So what this slide shows you, the blue column is the amount of tightening that was priced in 2016, 2017, and 2018 by markets, and the green column shows you how much tightening was priced in at the end of the quarter. And you can see it was a significant reduction in the amount of tightening. So this obviously moved interest rates. The second and arguably more important, this change in interest rate policy affected the dollar. So this is the broad trade-weighted dollar, and it shows how the dollar, the shaded area is Q1, how the dollar was rallying through January and into February, and then how it reversed. So why was this calming to markets? The dollar is always thought of in a relative term. It's dollar versus yen, or dollar versus euro, or dollar versus the Colombian peso. So what mattered here was dollar versus China. Decreasing the upward pressure on the dollar by definition, decreases the downward pressure on the Chinese currency, which lessens the market's concern about a devaluation. So the calming in the CNY, which was part of the dollar weakness, was calming to markets as well. So these factors had a big impact on global markets. The yellow line is the MSCI All World Index, and I chose that index rather than to show you many different countries' index, because all these charts basically look the same. Down hard in January, a little bit of rally, and then new lows by mid-February, and then almost a strong upward bias straight line into the end of the quarter. At the same time, the green line, the Chinese currency, which I showed you before, it eased in its pressure as well, and you can see how that stabilized and actually reversed its earlier declines. And then lastly, this slide is meant to show you a timeline of the different policy speeches and policy actions and how they played into the first quarter and how markets reacted from there. So let me take a second and pause before I have a couple quick thoughts on Brexit to see if there's any questions or comments on Q1.
I might have a question. And you might be addressing this with Brexit, but on earlier slides talking about kind of yields, and just get your thoughts on the kind of the German 10-year bond going negative. And I know this is outside of the first quarter, but just want to get your thoughts on that.
A few factors. Their funds rate is now minus 40 basis points. Ours is 37.5. So that delta argues for just a different valuation standpoint. The second one I would say is the U.S. has stopped quantitative easing, where Europe is in the midst of it, and they have increased it. They divide their QE by the capital key as their contribution into EU, with Germany being the largest contributor. So there's more boons bought than any other government bond market. I think it's a combination of those factors. And then I would add, most recently in the past couple days, and we'll get into this in the next one, that if Leave wins, there's going to be different flights to quality, and the flight to quality within Europe is going to be to Germany and away from the peripherals.
Any other questions for Mike?
Yes, a quick question. What kind of influence does the IMF have on the European Central Bank?
The IMF.
Or maybe there isn't any.
No, good question. I'm pausing because I'm not sure I know the answer. I would think meaningful, because the head of the IMF has always been someone from France, while the head of the World Bank has always been an American. So I think there's more coordination in there. So I think it's influential. I think the IMF is very, very widely respected by central bankers. So I think there's a positive. I think they do listen.
The why I asked it, because I thought Christine Lagarde wanted the ECB to do something earlier. Is that accurate?
Yes. In December, I think market expectations were them to do something. And the data was terrible leading up into that. And the forecast by the ECB staff called for lower growth and lower inflation, and the ECB chose not to move. And it was a big question mark. Like, why? Have they done enough? You know, and the ECB is split between the northern and the southern counterparts, with the northern being more fiscally conservative and the southern being less fiscally conservative. So there were some questions that maybe the dynamics had changed, such that Draghi couldn't get through what he wanted to get through, who's obviously Italian. So it's typical that my time in front of you was spent on Q1. Not on forward-looking things, but given the magnitude of the potential magnitude on markets of this vote in a week, I thought it would be worthwhile to spend a couple minutes on it and to answer any questions. So what the third referendum since 1973 for the UK, so these don't happen very often. And the question is remain or leave to the question on your slide. So let me spend a couple minutes on the polls versus the betting markets versus market expectations. So if you probably followed in the press, the polls have shifted slightly favorable to remain to slightly favorable towards the leave camp. The betting markets have shifted from almost 70% probability of remain to almost 60% probability of remain. So there's some dynamics changing in the markets, and in the polls in the betting markets. And there's all sorts of different theories as to what's happening in the polls, and the older voters versus the newer voters, the online polls versus the telephone polls, and I'm not going to bore you with that. Financial market expectations are an interesting one. So in volatility markets, there's what's a term called the put-call skew. And what that simply does is measures the relative value of a put versus the relative value of a call. In the pound, so the currency of the UK, the puts are 9 times more expensive than the calls, which is just an unprecedented ratio, and it speaks to the level of concern that's being evidenced in the currency markets. What's also interesting about that put-call skew is that's only for the 1-month horizon. The 12-month horizon is virtually unchanged from where it was a year ago. So markets are thinking this is a binary event on the remain versus the leave. So I think the remain is pretty straightforward. It's going to be a calming event, so on and so forth. I think the leave one is the one that it worries markets more than anything else. Obviously impacts on the UK economy, how they negotiate the exit. They negotiate with both the EU body as well as the 27 countries. They have to negotiate new trade agreements with every other trading partner. Most likely the UK goes into recession. The central bank eases, the currency weakens. But to me, the bigger questions are the broader implications of this. And I think it feeds a few different themes that are global. One is anti-incumbent. One is this anti-trade versus free trade debate that's going on in the world. One is this anti-immigration versus non-anti-immigration that's going on. When you get into the immigration in the UK, it's a big part of the Remain versus Leave debate. Over the past year, there's been 330,000 net immigrants into the UK versus what Cameron had promised to be in the low tens of thousands. And that I think is the heart of one of the debates, and I think it's at the heart of one of the debates in our election coming up as well. So let me just leave it there and answer any questions I can on Brexit.
Okay.
Any questions on Brexit? No. Okay.
Thanks
Thank
very
you.
much, Mike.
Thank you, Mike.
We don't always spend this much time on macro issues, but I think you can appreciate from the deck that Mike just took you through how important the macro crosswinds are to the current times that we're in. And, Brexit is a perfect example of it. And I think you can see from listening to Mike talk for a while how lucky we are to have Mike Haddad at the Bureau of Asset Management to help raise our game in terms of our understanding of the crosswinds of the macro economy, because it's our managers. We farm out all the money to external managers. Our managers are in a stress environment, and the first quarter was a super stress environment. And so for us to understand what kind of job they're doing, we have to understand the environment that they're in enough to be able to discern whether they're acting in a consistent fashion. And so the results I'm going to show you from the first quarter are a little dull. Thank God. Because there's a lot of places to go wrong during that quarter. The first 10 days of the year, it looked like the world was coming to an end. And if you're one of our managers sitting there with a variety of positions, the temptation to abandon ship on the long-term plan was huge. And so although the period-to-period results are kind of dull, this is a wonderful time to take a look at the portfolio and how it's doing and how our managers have done. It's a short period of time. We're long-term investors. But what we're more interested in is, are our managers being consistent in the process by which they use to invest the money of the 715,000 people who benefit from these plans. So let me just take you through the net results for the first quarter. As Mike already showed you, from a market perspective, it was a little dull. Here you see what actually happened in the 5 systems. We've listed them as we do each quarter by their volatility or their riskiness. And the BRRRR portfolio, because it has a riskier allocation, was the most volatile over the past year, 10.2% standard deviation, going down to NYSERS at 8.2. So the bottom 4 are similar, and BRRRR is a bit of an outlier. You can see in the next quarter, during the next column, during the first quarter, although there were some differences in the total returns, these are net of fees, for each of the 5 systems, they were all above the median fund at 1.1%. So even BRRRR that was taking more risks during this environment scored above the median fund. Some, like NYSERS and teachers, were well above the median fund. As you go out to 3-year and 5-year, you can see that while there's a lot of differences in a quarterly basis, the more important 3- and 5-year results are very tight with the underlying benchmark. We're getting similar results to the Tux universe, which is all funds, and the funds themselves are more similar in terms of their return. And now on a 3-year and 5-year basis, they're just under our 7% long-term trend. And if you're Sherry Chan, our chief actuary, none of these numbers are long enough. These are all short-term numbers. And when she puts together forecasts of what we can expect over 30-year time periods, she's still comfortable with 7%. But we are going through real stress test, as Mike just outlined, and a period of time where we're likely to get very low returns, subnormal returns. For a couple of years. That doesn't mean that our long-term expectations have changed when you move the lens out to a 20 or 30-year time frame. Here's the asset allocation. You've gotten used to seeing these bubble charts. The size of the bubble is the size of the allocation. You've got different colors for each system. Fire is always red. Police is always blue. Those are easy to remember. NYSERS is always orange. Teachers is always yellow. BRRRR is always green. Those color schemes will be in place throughout the entire presentation. Up at the top of the slide, you can see the page number in your book that this information is on if you want to look along on the page numbers, but I'll warn you, you'll be flipping all over the place, but just so you have a record. This is all, the materials that I'm going to show you is all in your books. You can see that the domestic equity, where most of the allocation is right on target. If you're close to the middle line, our footing at the end of the quarter was exactly on our long-term target. So we're on target on equities kind of across the board, with private equity slightly above on a long-term basis, and that moves around because the private equity is marked with a lag, and it's marked less frequently than the underlying publics. So nothing unusual here. We're right on target with our long-term allocation. In the fixed side, a little bit more explanation is needed. All the way on the right, we have our short-term U.S. Treasuries, and all the way on the left, we have Core Plus 5, which includes Treasuries, just not the short-term. If you mush them together, you have something that looks much closer to the target, and it has a duration or interest sensitivity that is similar to the overall market as measured by the Barclays Index. High yield is on trend. TIPS at the end of the first quarter were underweight, and they had been underweight for a while. We got to a place where the break-even inflation was at extremely low levels. The asset allocation group at Bureau of Asset Management decided it was time to move that to the target weight, and so we have now moved the allocation to even for TIPS, and we took some of the cash money to do it. So that gives you a sense of where we are across the fixed income, more or less in place. Our philosophy is not to do a lot of tactical allocation, but to rebalance. And when markets are choppy, as we saw in the first quarter, rebalancing wins because you're selling a little bit when the market or the segment is high, and you're buying a little bit when it's low. So we believe in this. We have had some tactical, longer-term tactical tilts. We talk them through with the trustees every time we do that. We'll continue that practice as long as the Stringer administration's in office. Now we'll turn to, I just want to give you a peek at the fiscal year results. We don't typically do this, but we're getting towards the end of the fiscal year so that you can see the benchmark and the total portfolio for each of the systems. It's been a pretty flat year, and we're almost exactly flat in a benchmark sense. The portfolio a little under. We're still less than 200 basis points negative on all the portfolios. And you can see the value added, or the difference between the benchmark and the portfolio, in the right-hand side. Underwater a little bit relative to the benchmark, most of it coming from manager value added relative to benchmark rather than asset allocation because of our policy to be pretty neutral with the target. If I could have just a little water, if there's somebody could get a glass. I'm going to go back now to the calendar year results, and I'm going to stick with calendar results going forward. This is the first quarter. You can see that net, the first quarter was up across our total portfolio, 1.5 to 2 percentage points for the benchmark. And our portfolios, thank you, Brian, our portfolios were almost exactly on that, very slightly below benchmark for the quarter. Pretty similar across the different systems. Now this is dull. There's not a lot going on, but I'm going to take you through all the detail. I'll take you fast. If you want to slow me down, please do so. But there's not a heck of a lot here. I'm going to blow it up now. This is before plus or minus 600 basis points. I'm going to blow up that first quarter excess on the right so we can get a good look at it. Now it's on the left and we've blown it up. Same numbers, they've just been expanded. And you can see that relative to the benchmark, our excess return is about 50 to 60 basis points under, with FIRE being a little more under. We break it down into asset allocation and manager value added. If you're staying close to the benchmark, you're not doing a lot of tactical asset allocation, you would expect that whether you're above or below the benchmark, that most of it's coming from manager performance. And in fact, this is what this is telling you, that the great bulk of the difference is in manager performance. So the rest of the presentation is going to focus on manager value added. The difference between the manager's return and the benchmark, not looking at whether we're under or overweight the sector, which is all captured in the asset allocation. This is the total portfolio. I've gone back to the plus or minus 600 basis points. Going to stick with that so that the scale is all consistent. Notice that for the first quarter, the year-to-date, calendar year-to-date, and the first quarter is the same number. So you can ignore that middle column. It's always going to be the same as the left column. And you can compare it to the full calendar year 2015 in the right-hand column. So very slight underperformance for the total portfolio. Here's equities, they're a portion of it. Equities were almost totally flat except for NYSERS, which was up. A lot of that had to do with their position in having less mid-cap managers. John Mersberg's going to, and there are a couple other cross currents, John Mersberg's going to take you through the details of that. They had a slightly different mix than the other portfolios had. He'll go through that in the executive session. But you can say it made a slight difference. The others were almost flat in equities. In developed equities, or the international and non-emerging market, we added value to the portfolio during the during the quarter across the board. In emerging equities, we underperformed across the board. It was a very, very tough area to be in. As you know, Mike explained what was going on, all the uncertainty about China and everything, and they are the extreme part of the economy getting moved around, and the macro winds are really affecting those emerging funds. And as you'll hear in an executive session, Burrs had above average exposure to one of the managers, very fine manager, but they underperformed during the quarter. Core fixed income, very flat versus the benchmark. Tips, you can't even see them. Why is that? It's not a misprint. They're indexed. And when you're indexed, there is no value added relative to the benchmark. So it's a good check. We shouldn't have anything going on in that area, and we don't. Economically targeted investments were positive. This is where we're making affordable loans in and around New York City. This has been a stalwart part of the portfolio. We wish we can do more of these loans. They're fully guaranteed by the state government, and we're out there trying to do as much of this as we can. Brian and his team will be here this afternoon to talk to you about the details. Bank loans were a little under water, particularly at Burrs and Fire, but very slightly. And same sort of thing in high yield, very slight underperformance. This is not bad considering the environment. Convertible bonds, we're getting some good performance here. Why is this? The primary influence, and Robert will take you through the ins and outs, the primary influence, most of our convertible managers stay away from all the junky stuff. And the junky stuff, as you can imagine, was going nuts during the quarter, and so being positioned in the higher quality names was beneficial, and so we had a good quarter in convertible bonds. Hedge funds. Hedge funds lost money during the quarter, but they lost less money than the general hedge fund index. Okay, and so it's a positive result relative to benchmark. So the team, when they get up here this afternoon to go through it, are not going to be satisfied because they don't like to lose money. But we lost less money than the average hedge fund, and that's the way relative value works. So we added value during the quarter. Private market data. I'm going to switch gears because we don't get much information out of the quarterly data. We don't get that much information out of the time-weighted data, as we've talked about. We're going to look at dollar-weighted results over the full period of time that we've been investing. To answer the question, are we better off having invested in these asset classes than we would have been if we just left the money in the public markets, the so-called public market equivalents? And the way we measure this is we do a calculation. Every time the managers draw down money, we say, well, what if we just kept the money in the appropriate public market, the place that we took the money? So in private equity, we take the money from the Russell 3000. If we just left it there, how are we doing? That's what this is going to show us. It's the ultimate test. Now, for private equity, again, we're comparing to the Russell 3000 for our domestic private equity and to the Morgan Stanley indexes for the international. And we want to get 300 basis points of outperformance, 3% more than the market is giving us, because we're taking risks in private equity. We lock the money up. They're more levered. We expect a little bit more than we're giving up for the Russell 3000. And we haven't gotten it back. So we're not satisfied with these results. However, the results are positive. And as you look at it, you can see that we've been at this a long time. We've been at this since before your current team at BAM was here. Started with Larry Schloss in 2010, taking a different approach to private equity, narrower focus on proven high-quality managers, larger allocations. Great strategy. Alex Danier and his team have worked the same strategy that Larry put in place. It's beginning to pay off. So we've gone from very negative results here to the fact that we're neutral to positive across the board. So we've come a long way on this. We're happy with the progress. And as you'll see, as we look at the younger asset classes that have been in place for longer periods of time, they have even better results. Infrastructure. Now, infrastructure has only been around, as you can see on the right, since 2013. And we're, 800 to 1,000 basis points better off than we would have been if we had half our money in public equities and half our money in bonds. This has been a good trade. Petya and her team have put us into managers that, despite the fees, despite the lockup and the extra leverage, they have produced very acceptable returns. In private real estate, we see the same kind of thing, and this has been a work in progress as well. Now, we expect a premium over private real estate because this includes both core real estate and opportunistic real estate. And so while we're happy with BRRRR's results at 500 basis points, if you look down to the right, you can see BRRRR's is a much newer program. Right, so they were investing in real estate once the Bureau had changed its philosophy, whereas the other systems were, more of these results started in the early 2000s when it was a more dispersed strategy, and there were some partnerships that didn't work out as well. So the newer partnerships are kicking in, and that's a consistent theme through the private asset classes. Opportunistic fixed income, a fairly new program with disappointing results. We've showed you good results, heretofore. It was a tough period for them, and Wesley will talk to you about it. This is, it's a high benchmark. This is, if we don't invest in opportunistic fixed income, we would keep the money in high yield mandates. And this gives you a sense of how we would have done if we just kept the money in the JP Morgan high yield index. And we're about the same. So we haven't lost money relative to just keeping the money in high yield, but we're not getting the premium that we expect long term. Wesley will take you through the ins and outs of that. That's all I have on our results, but I'm happy to take any questions that you have. Hearing none, Mr. Facilitator, this concludes our remarks for the public session.
Okay, I'd just like to ask trustees who have come in since we did the roll calls to introduce themselves for the record by fund. So let's go in the same order. Anyone come in from NYSERS?
Aldrin Bonilla, NYSERS.
Aldrin, and which trustee do you represent?
Manhattan Borough President.
Thank you.
Angelina Martinez Rubio, Queensboro President's Office.
John Fusco, Staten Island Borough President's Office, NYSER.
Okay, thanks. Teachers?
Good morning. Ray Sanchez, Bronx Borough President, Ruben Diaz Jr.
Okay, thanks. Oh, yeah. Any other trustees from NYSERS?
Letitia James, Public Advocate.
Thank you. Okay, teachers, anybody come in since we did the roll call? What a surprise, the teachers were all on time. Okay, fire?
Doug White, late.
What, Doug, who do you represent?
Oh, fire.
Fire Commissioner.
John Kelly, UFA.
Thank you.
Firefighters.
Anyone else from fire?
Also late.
Okay, police?
Good morning. Joe Alejandro, designee for Pat Lynch and John Puglisi. And I have to say, unfortunately, Vision Zero should be a little reversed. It's zero vision when regards to traffic, I'll tell you that much. So.
Thank you for that excuse, Officer Alejandro.
Michael Palladino, DEA.
Lou Turco, LBA.
Okay, that's it for police. And anyone from BERS? No. Okay, very good. All right, so now we need a motion. Do we need a motion from each fund? I forget. Yes, okay. So we need a motion from each fund to exit public session and move into executive session. So can we get a motion to that effect from the NYSERS board?
So moved.
Is there a second? Okay, motion moved and seconded. Any discussion? All in favor of the motion, please say aye. Aye. All opposed, please say nay. Any abstentions? Okay, the NYSERS board is now in executive session. Teachers, can we get a motion to move into executive session?
Tom Brown. I make a motion pursuant to Public Officer Law, Section 105, to move into executive session for discussions regarding the purchase and sale of securities and updates on specific investment matters.
Second.
Okay, motion moved and seconded. Any discussion? All in favor of the motion, please say aye. All opposed, please say nay. Any abstentions? Okay, so teachers is now in executive session. Fire, can we get a motion to move into executive session?
So moved.
John Kelly. Is there a second?
Second.
Jim McGowan. Okay, motion made and seconded. Any discussion? All in favor of the motion from fire to move into executive session, please say aye.
Aye.
Any, all opposed? Any abstentions? Okay, the motion carries. Police.
Motion to go into executive session.
Second.
John Dorsa. Okay, motion made and seconded. Any discussion? All in favor of the motion police to move into executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Okay, the motion carries. And BERS, no, we don't, you don't have a quorum. Okay, so BERS, we're good. Okay, so all the funds are now in executive session. Can we please turn off the camera?
Out of executive session and into public session.
All right.
So, second.
All right. Okay, all in favor? Aye. Any opposed? Any abstentions? Hearing none? All right, just turn the cameras back on.
I might add, you didn't do roll call. Usually there's a roll call when you do that, I think, for...
No.
Okay, I'm fine.
No roll call.
Okay, we have a lot of advisors, yes. Let's go.
Okay. Yeah, and fire, you guys want to go into public too?
Wait, hold on.
Okay. Just teachers? Okay.
Hold on.
Okay. Gotcha. All right, cool.
Ron Swingle, New York City Teachers. In the executive session, 2 real estate investments were presented and discussed. Consensus was reached, which will be announced at the appropriate time. 1 private equity investment was presented and discussed. Consensus was reached, which will be announced at the appropriate time. The scope of an upcoming RFP for an asset class was discussed, consensus was reached, which will be announced at the appropriate time. An opportunistic fixed income investment was presented and discussed, consensus was reached, which will be announced at the appropriate time. A manager for a specific asset class was discussed, consensus was reached, which will be announced at the appropriate time. And finally, in-depth reviews of each asset class were presented.
Okay. All right, thank you. If there's nothing else, need a motion to adjourn. All right, is there a second? All those in favor, say aye. All right, any opposed? Any abstentions? All right, meeting's adjourned. Thank you.
The guy with the two last names, Sanskrit. Read now. Okay. All right, the fund concurred with the controller's recommendation to hire 4 investment firms. That will be announced at the appropriate time. The police pension fund also concurred with the recommendation to commence with a manager search and initiate actions by a manager. That will be announced at the appropriate time. Fund also concurred with the recommendation to terminate managers and transfer funds to existing managers. Details to be announced at appropriate time. And the fund took action on the transfer of ownership of positions from another retirement system, and that information will be announced at the appropriate time.
Okay, all right, thank you. Now I need a motion to adjourn. Motion to adjourn. All right, there's a second. All right, all those in favor, please say aye. Aye. Any opposed? Any abstentions? All right, we are adjourned. Thank you.
As well as to terminate. Those decisions will be announced at an appropriate time.
Thank you.
Now you want to do the variable supplement, is that it? We have to do roll call of such trustees. Go ahead.
For the firefighter VSF fund, Mr. John Adler,
Yes.
Ms. Susanna Vickers,
John Dorser for Controller Stringer.
Mr. Antonio Rodriguez,
Here.
Mr. James Levin,
Vince Speciale, proxy for James Slevin.
and Mr. Eddie Brown.
Eddie Brown here.
Okay, we have a quorum. We can start the VSF fund meeting.
So the quarterly reports for the Firefighters Variable Supplements Fund have been provided to the trustees. At this time, if there are any questions, we'll be happy to answer those. If not, we have no business before the board.
So therefore, there's a motion. You have to have a motion to move out of executive session of the firefighters variable supplement.
We're in public session. Oh, excuse me. No, we have nothing in executive.
Okay.
We have nothing in executive.
So what do we? I'm sorry. What are we doing?
So there are additional information provided in the quarterly report, which we'd be happy to answer at a later date and go through in conjunction with another meeting. I don't believe that there's any questions related to that would cause us to go into executive at this time.
Okay. So I think we need. What was it?
So we would move to.
We would adjourn this part of the meeting
to exit.
And move into the. We need a motion apparently. We need a motion to.
We'll make a motion to exit the public session of the.
Go ahead.
A second. Okay.
Is there a second?
Yeah, I seconded.
Yeah. Okay, so the meeting is adjourned.
Yes.
So we now need we need to open the fire officer's variable supplement, and we need to call a roll for that. Call it.
Mr. John Adler,
Yes.
Ms. Susanna Vickers, Mr. Antonio Rodriguez,
Here.
Mr. James McGowan,
Here.
Mr. John Farina.
Here.
I have a quorum. We can start the meeting.
So the materials for the Fire Officers Variable Supplements Fund was previously provided to the board, as it is each quarter. At this time, we'll take any questions related to the presentation materials, but if there are none, we have no other business before the committee or the board.
Yeah, we have no questions.
Okay.
So do we need a motion to adjourn this part of the meeting?
Yes.
Public session?
So will the Controls Officer make a motion to adjourn the public session of the Fire Officers Variable Supplements Fund?
Second.
Any objections?
James.
No objections, I guess we're adjourned, okay?
Correct.
All right?
Thank you, John.
We're done. We're done. Thank you, Caroline, thank you.
need to report out they already reported.
Okay, yeah. Yeah, cool. That's fine. The nicest, yeah.
Okay.
You got it. You're the nicest.
Let's see what I need here.
Okay,
What do I want?
so can we get a report out of the executive session of NYSERS?
Take care, buddy. Take care, take care.
Yes. Is it
Oh,
on?
sorry, we have to adjourn out. I'm mistaken. So we are still in executive session. We need a motion to exit executive session, enter public session. Thank you. Is there a second?
Okay.
Dave Katzman, okay. Any discussion? All in favor of the motion to exit executive session, please say aye. Aye. All opposed, say nay. Any abstentions? Okay, motion carries. We're now in public session. Can we get a report out of executive session for NYSERS?
Yes. NYSERS took action on the following investments, details of which will be disclosed upon the finalization of the contracts. 2 real estate, 1 private equity. NYSERS also accepted the recommendation of BAM to issue a search for public equity funds of funds emerging managers.
Okay, thank you very much. So we now need a motion to adjourn. Is there a second? Second. Any discussion? All in favor of the motion to adjourn, please say aye. Any opposed, please say nay. Any abstentions? Okay, the meeting is adjourned. And I think that does it for the whole kit and caboodle here. Okay, thank you very much, everybody. Have a great evening.